Hey, good morning, everyone. It's 10 a.m. We're going to get started. I appreciate you joining me this Saturday morning. We're going to be talking about tax strategy today and hopefully give you some good information at the top of the year, the end of this year, going into the beginning of 2019. A couple different things. If you haven't been on one of these prior, just know that if you have any questions, if I'm going to move through some things pretty quickly this morning. If you have any questions, please dump them into the side box. There should be an option for you to add questions right to your side panel. I'm going to stop periodically, or I might just move through depending on how quickly things go and answer questions towards the end of the presentation. Um, so if you have any questions, please, just like I said, toss them in there and I'll try to get to them as quickly as possible. So let's get right into it. If we've met prior, great. If we haven't, I just want to quickly introduce myself, who I am, and tell you a little bit more about me. My name is Willie Mandrell. I am a real estate investor, have been since 2006, so 12, 13 years now. Bought my first multifamily in 2006 and fell in love with the business and been investing ever since. My primary focus is the buy and hold market, or the buy and hold business, buying, fixing up properties, renting them out, and playing the long game, opposed to flipping and some other things that I've been involved in, but that is my primary focus as a real estate investor. I'm also a real estate broker. I am the broker and owner of the Mandrell Company. The Mandrell Company is a residential and commercial real estate office, and we focus on helping people like yourself find opportunities within the real estate business to invest, land opportunities to develop. Just anybody from your inexperienced investor who's buying their first multifamily to somebody who has a 200 unit portfolio, and everyone in between are the people that we try to assist. We try to assist you in buying, and when you're going to selling properly, using 1031 exchange and some of the things that we're going to talk about today to defer taxes and maximize your wealth building strategy. And last but not least, I am one of the organizers of Boston Wealth Builders, which you are a part of today. Boston Wealth Builders started back in 2012. To be honest with you, the start of it originated because I was looking for like-minded people. Wanted to get into the business, really loved the business, and wanted to push forward. And there weren't a lot of people in my immediate circle that had that same passion. So I discovered meetup.com, created Boston Wealth Builders, and have been able to connect with a lot of great like-minded people in the business, real estate agents, investors, wholesalers, other developers, other just people. It's been a great network, and I encourage you to get involved with as many meetings as you can and meet the people out there and get involved in some discussions. There are a lot of great people in the group, and hopefully it continues to grow at the rate it has been. So that's me, investor, broker, and organizer. If I can help with anything, if we haven't met prior, please reach out. You can reach me through the Meetup platform, or I'll provide my email address and contact information at the conclusion of this as well. So again, thanks again for hopping on this morning. We're going to be talking about tax strategy. I'm going to say it multiple times, and I just want to make sure that it is clear. Feel free to ask questions, but I want to make sure that people understand that I am not an attorney. I'm not a CPA. My goal today is to give you something to think about, some things that I'm discussing with my attorneys and my CPA, the people that do my taxes, some of the things that I think about over the year. When you're not in the business and when you're not necessarily a business owner, and you just getting into the real estate business, you think taxes are something that you do at the end of the year. You're prepping your tax returns and you're filing ones. Taxes is something that you really want to think about throughout the year. It's something that when you're making a purchase, every time I go to Home Depot, every time I'm paying an invoice, on anything. I'm thinking about tax strategy. I'm thinking about how can I write this off? How can I, make this a deduction on my taxes, and just kind of thinking about that and being strategic. So one of the questions I wanted to answer, and hopefully maybe somebody has this as we go through, is why didn't you have a CPA talk to us today? And I've tried that in the past, and I thought that though I'm not a CPA and I don't have all the intricate details of every tax strategy, CPAs and attorneys tend to go too in depth about a lot of things that are unnecessary. We spent I think I did this a couple of years ago, and we spent about 3 hours on a strategy webinar that it was completely unnecessary. So they tend to be a little bit too technical. My goal today, over the next 60 minutes or so that we're going to spend with this, is to get you thinking about it, and then you can tax laws change on a regular basis. So you talk to your CPA and answer the questions based on where you are, what you're trying to do. I just want to open up your mind to some of the possibilities. And one of the reasons that I think tax is one of the coolest things about being in the real estate business. So hopping right into it, a couple of things that we're going to talk about today, and this may spin off into a couple other different topics as well. Boston's residential tax exemption. Some of you may be already aware of it or familiar with it. Some of you may not. The 1031 exchange, the trade-up tax laws for real estate investors. Equity stripping, that actually, I'm going to talk to you a little bit about that, but that actually changed, and I forgot to change it on the agenda. We're going to talk to you a little bit about just kind of knowing your tax deductions and getting really in depth about your tax deductions, but we can also talk about what equity stripping is as well. Self-directed IRAs, which I think are really, really cool, really, really neat product that will maybe some of you are familiar with already. Some of you may not be. I'll introduce those to you. Business travel and education. Lead paint tax credits, which I absolutely killed it with last year, and then putting your kids to work. We'll talk a little bit about that as well. So those are the things that we're going to discuss this morning. I'm going to go into each one of them, maybe 10 minutes on each. And again, for those of you who are just hopping on, if you have questions, please dump them into the question box, and I'll try to get to them as we go through. So again, here's your disclaimer, your disclosure. Ask as many questions. I'll try to answer them the best way I can. But please note that myself nor the company provides accounting or legal advice. You really want to consult your CPA for anything that you hear here, and make sure that it's within your tax situation. It falls within the guidelines of what you're trying to accomplish. Not everything on here is for everyone. There are certain things that are going to apply to business owners, certain things that are going to apply to someone who owns a single family home, whatever it may be. So you really want to, again, seek legal and accounting advice from your professionals. So the first is the thing that we'll talk about is the residential tax exemption here in Boston. The reason I put this on here, some of you may be very familiar with it already, but I work with obviously a lot of buyers and sellers through the brokerage business, and I come across many that were very unfamiliar with the fact that the city of Boston offers a residential tax exemption. Obviously, if you're buying in Quincy, I don't know what they offer. If you're buying in Medford or in Melrose, that's something different, but this applies to the city of Boston. The city of Boston has this residential tax exemption to encourage people to buy and stay and live within the city. As you're well aware, we have a lot of colleges, we have a lot of opportunities for landlords to come in, buy a rental property, live somewhere else, and just hold those properties as rentals. While the city is not opposed to that, we do need rentals. They do want to encourage people to live in the properties as well. So the residential tax exemption is basically when you buy a condo, a single family, a multifamily, and you live in that property, you have property taxes. If you're a property owner, I guess the easiest way is for me to give you an example. I own, a three-family in Dorchester, city of Boston. I'm paying roughly $5,500 a year in city taxes. Those taxes are property taxes. Those taxes go to the city to cover, roads and everything else. If I were to live in that property, I would apply for my residential tax exemption, and I would have a reduction on those city taxes or those property taxes. Last time I checked, and please, this is where, like I said, you really want to check with your tax professionals. And I think this is something that you can actually apply for and really Google pretty easily and figure out exactly what the number is. But I believe it was $1,800 to $2,000 off of that number. So if I lived in the property, owner occupied the property, that $5,500 tax rate that I'm paying right now, that tax bill would be reduced by roughly $2,000. Why do I bring this up again? If you're living in a property right now and you had no idea about this, then that's exactly why. But the other side of it is if you're planning to buy a property, if you're planning to buy real estate, you go to get a pre-approval from your lender, and your lender may not necessarily know exactly where you're trying to live. They're basically going to give you a general pre-approval and say you can go to Quincy, you can go to Malden, you can go to Everett. It doesn't really matter to us as long as the numbers make sense. But understanding that you may be able to afford a little bit more because of the residential tax exemption that you're going to get by living in the city of Boston. So if you do end up getting something in South Boston or Dorchester or East Boston, making sure that your lender is aware of the possibility of getting that residential tax exemption. So that was it. I think that was all I had to say on that. Make sure that you're aware of it. There may be other exemptions in other cities. I would definitely look them up if you're planning on buying outside of Boston. Definitely look up and see what that town or the municipality has to offer. Excuse me. The 1031 exchange, really cool opportunity. If you already own property, the 1031 exchange. Well, let me tell you. Let's back up and talk about how things would typically work without the 1031 exchange. I give you a perfect example, and I'll talk about myself because like I said, I obviously know my situation. Instead of giving you, generic hypotheticals, I bought a property in 2012 for roughly $400,000, and today that property is worth roughly $800,000. So a $400,000 gain on the equity or the value of that property. Over time, I've also been taking deductions. That mortgage balance is also being paid down over time as well. My tenants are paying rent. I'm using that rental income to pay down the mortgage. So there's been a separation. Hopefully, all of you understand what I mean when I say equity. Equity is basically the difference between the debt on the property and what the property is worth. So in the very clean numbers, we'll keep this clean. When we won't even include the mortgage pay down. We'll just say that the property I still owe $400,000 on the property, and now it's worth $800,000. If I sold the property today, that gain I'm going to be taxed on. And let's keep the math really simple. And basically, let's say that capital gains taxes are 20 to 25%. Let's use a higher number and say 25%. And then state taxes are also 5%. So if we look at that and we basically say, I sell the property for $800,000, and I bought it for $400,000. I had a gain of $400,000. And again, to keep the math simple, let's say the total number is 25%. I'm going to pay roughly $100,000 in taxes, in capital gains taxes on the sale of that property. That's just not a comfortable position to be in. It's just not. Again, you've had the great fortune of having that property appreciate over time, but to turn around and write a $100,000 check to the government is never an easy thing. There are a lot of people that get involved in a sale like this, and I've worked with these clients, and they get involved in the sale. They do not pay their taxes immediately. They get in trouble, and all of a sudden now you have a $100,000 note, and that's how, like I said, tax problems happen, and you get yourself in trouble. The easiest thing to do would be to pay that immediately. So here's where the 1031 exchange comes in. If I wanted to sell that property and I needed the cash immediately, and for health reasons or financial reasons, then yes, maybe I don't have the opportunity. Maybe I need to sell and move on and pay those taxes. But if I'm selling a property, potentially buy a larger property, like the gentleman in this photo, he's trading up. He's going from one smaller house to a much larger house. And by that I mean rental property. This does not apply to your own personal residence. That's a completely different situation. If you live there, it's a single family, you do not need a 1031 exchange. This is for investment real estate and real estate that you do not occupy yourself. I'm selling that property and I'm looking to trade up to a larger investment. Right now I have a 3-family and I want to take the proceeds from that 3-family sale and buy a 20-unit building. Or let's make the numbers easy. It's an $800,000 building. I want to go buy a $2 million building right now. I can use the 1031 exchange to defer all taxes. That $100,000 tax, the check that I would have written to the government, I no longer need to do. I'm going to sell the first property, and within the guidelines, within the timing guidelines and everything else, take those proceeds and go through a 1031 exchange sponsor, and use those proceeds to buy as a down payment on a larger property, if that makes sense, right? So now I'm taking $400,000, paying no taxes on it, and potentially, going out and buying a $2 million property. If I can get a bank to fund it with an 20% down, down payment, I can take that $400,000 and now go buy a $2 million property with 10 units or whatever it may be. So that's what your 1031 exchange is. It completely defers all taxes. You can now do the same thing. That $2 million property appreciates and now it's worth $4 million. You can take the proceeds from that and go buy a $10 million property and defer those taxes over and over again. Eventually, if you do sell, you're going to have to, pay the man at some point. The federal and state government are going to come for their taxes eventually. But you can defer, and that's how people start off with a 2-family and end up with 20 units by just going through this 1031 exchange. A quick side note, for those of you who own, let's say you own a 3-family, but you own or occupy, you live in the 3-family right now. If you go to sell, if you live there, and I believe, and again, talk to your CPA, if you live there in the last, I believe, 24 to 36 months, you do not need a 1031 exchange. You will have your capital gains. You can actually defer capital gains up to, I believe, it's 250,000 or as a single person, or 500,000 as a married couple. Under the current tax law, you do not need a 1031 exchange. You would pay no taxes on your capital gains if you're under $250,000 or $500,000 as a married individual. So you could sell at any time and not have to worry about the tax consequences if you're under those numbers, if that makes sense to you. And if it doesn't, please, again, throw something in the question box and I'll clarify what I can for you. Get all your deductions. Did I spell that right? Yep, I did. Getting all your deductions. One of the things, and I mentioned this in the very beginning, I'm constantly thinking about taxes throughout the year. I'm thinking about from the start of January till December, taxes are on my mind. I'm writing checks every day. I'm charging things on a credit card, a business credit card, a credit card that's directly related to my property. So I'm thinking about taxes, and if you are looking to get into this business to buy rental property, you should be, kind of thinking about the same thing. NOLO, there's a book brand, NOLO, NOLO. They have a annual tax deduction guide for landlords. It comes out every year. You should definitely think about getting a copy of it because it'll really open up your mind to, or open up your vision to a lot of different things that you can deduct being a landlord, owning a business. So let me start like this. Let's say, first of all, if you own rental property and you don't consider yourself a business owner, I think you should start to. If you are a landlord, you own rental property, you have rental income coming in, you have expenses going out, that is a business owner. You should start looking, regardless of whether you live there or not, you should start looking at yourself as a business owner. And I think you'll start to see opportunities within the tax code. They'll become a lot clearer to you. So let's start with some of the more generic ones, and then we'll move into some of the specifics, about how and why I, love the tax code so much, and especially being a business owner and being a landlord. So the biggest one that you'll get, and this may be clear to you, I think this is on the residential side anyway. I mean, whether you're a homeowner, the interest tax deduction. Most of your mortgage payment, for those of you who don't own homes or just starting, in the very beginning, you take out 30-year mortgage, and I would say in the first 5 years, I mean, most of your payment, I would say 90% of your payment is all interest to the bank. Interest that you pay to the bank on a home loan is tax deductible. So if your mortgage payment is, let's say, call it $2,000, and you're paying $1,800 in interest, $1,800 times 12 months, that is going to be a complete tax write-off for you against your employment income. So that is going to be one of the largest tax deductions you get, is that mortgage interest expense. The next one, for rental property owners, I do not believe that you get this if you are for a single family or a condo, if you own or occupy it, but is depreciation. So you buy a property at 500,000, and I believe the depreciation timeline is every year over. It's either 27 or 29. I believe it's 27. The government basically breaks down the value of that property. It's $400,000. They divide it by 27 years, and each year you get a depreciation expense that you can write off, and that goes against your earned income as well. So those are the two largest tax deductions that you will have. Both of those, I would honestly have a good conversation with your CPA and make sure that you're getting them. You actually have to take the depreciation deduction. And I think it'd be silly not to take the interest deduction as well. So you want to make sure that you fully understand that those things are on your taxes, and those are depreciating or depreciable expenses, for you. The next thing you would take is any repairs that you make. So if you you put on a new roof, that's a capital expense. We won't go into what the difference is, but know that that new roof is costing you money right now, but you're going to write that expense off on your taxes. If your refrigerator breaks in one of your rental units and you need a repairman to come out, that is an expense to you, and that's a write-off. So some of these things may be really obvious. Some of the things that may not be really obvious to you are, let's say, local travel. If you are using your vehicle to go back and forth to rental properties and deal with, making trips to Home Depot, and whatever else it is you do that you're traveling locally with your rental properties to repair those properties. Those are all that mileage, that gas, the wear and tear on your car is all tax deductible. I believe there's a couple different ways that you can write those things off. I believe you can either just total a mile up, and I believe there's again, consult your CPA, but I believe the last time I checked it was 15 or 19 cents per mile, which is, you can basically just say I drove 1,000 miles in relation to my rental property business. So if I'm, 19 cents per mile, I do the math. I think that's what you would end up with as a tax deduction. Again, that 19 cents per, I don't know that. I'm pretty sure. I've been in this business long enough to know that I don't remember what that exact number is, but I know that my CPA is constantly asking me every year, what mileage did I accumulate on my vehicle in relation to my rental business, or for me, I'm also a real estate agent in relation to my rental business as well. So 90% of the miles I would say that I drive are in some way related to my rental property business or the brokerage business itself, is a tax deduction for me every year. Another thing that may not be immediately obvious if you're not treating your rental property business like a business is your home office deduction. A portion of your, let's say, and again, we're talking about very simple math here. I don't want to make it more complex than it needs to be. Let's say that you have 5 rooms and they're all of equal size in your home. One of those 5 rooms is your home office that you use and you set up for computer. It's where you sit down and you collect rents and you make your phone calls and you have your filing cabinet, and you do maybe some mail marketing to go out there and look for other rental properties out of that home office. Well, if you have 5 rooms, they're all of equal size, and you're using one, you basically can write off, you get a home office deduction, and I believe a portion of your mortgage or your home cost, your heating, your electric bill, everything else, 20% of that, again, perfect world scenario, would be tax. It would be a tax deduction for you. You'd be able to write off a portion of your electricity bill, your Comcast bill, because you need internet to operate that business as well. So again, consult your CPA, but make sure that if you're looking at, establishing yourself in this business, building a business, buying 10, 15, 20 rentals, that you're possibly setting yourself up, even if it's something in your basement. A portion of your basement, can be written off. So you're going to have to work out that percentage or ratio of your home expenses with your accountant, but keep that in mind. Your insurance is a write-off. Your homeowner's insurance for those rental properties is a write-off. I also pay for umbrella coverage, which, like I said, if you have a question about, we could talk about, which is a write-off as well. Professional and legal services. So when I actually pay my accountant, when I pay my attorney, those are all write-offs for me as well. And then last but not least, if you have any employees, if you're brand new to the business, you're probably thinking, well, I definitely don't have any employees, but employees also, can be considered, virtual assistants as well. If you're hiring somebody, and quick side note, if you're in need of help, and you're like, hey, I can't hire anybody full time and it doesn't really make sense for me, check out Upwork.com, upwork.com. I've been able to hire virtual assistants all over the world, and do small projects, including web design and everything else for me. And those are considered employees as well. So the cost of you hiring these people to help you out in your business is also a tax write-off. And then we'll get into a little bit more about employees in 1 second. So self-directed IRAs. What is a self-directed IRA? I'm pretty sure most of you are familiar. We can talk a little bit about the traditional way for saving for retirement. Most of you have worked a W-2 job at some point, maybe still are currently working with a W-2 job. And basically what that means by W-2 job is basically you have an employer, you work 40 hours a week or 30, whatever it may be. Your employer cuts you a check at the end of that week or that bi-weekly period, and that's traditionally how things are set up. The problem with that, and one of the things that I would like you to, opportunities that I'd like to open you up to if you're not familiar with it already, your employer basically has, and I'm pretty sure most of you probably have your 401k if you're contributing to it, at Fidelity Investments. I think they're the biggest 401k provider and holder in the country. If not, I think there's a couple others, Chase and Wells Fargo and a couple other people, but I think Fidelity does most of them. So when you go into and you say, hey, you know what, I realize that retirement is important. I want to save money for retirement. I make 30, 40, 50, 60, $100,000 a year, and I want to put 10 to 15% away. Your employer takes it directly out of your check through HR. They put it over to your Fidelity account. You check out your Fidelity account, and you basically have 4 options or 5 options or maybe 10 options now in your Fidelity account. You have a Fidelity Freedom Fund. I don't even know what that means. You have a Fidelity Aggressive Growth Fund. You have a Fidelity Conservative Bond Fund. And you basically have these mutual fund options that you can put your money into. And you basically say, and not to get too complex and too deep into it, but that Fidelity Freedom Fund or that Fidelity Aggressive Growth Fund is run by a fund manager. That fund manager, depending on the strategy of that fund, goes out and picks stocks and in bonds and in other items to invest in. And depending on the performance or how well that fund manager does, that's how your 401k performs, if that makes sense, right? So if, let's say, and again, to keep math really simple and really straightforward, let's say the total pot that fund manager is managing is $1,000, and of that you have $100 in there. Well, 10% of what he does with that $1,000 is going to affect your 100, and that's how your 401k performs. That's how almost 90% of the people on this webinar are set up, and that's how most of America is set up. The problem that you find with that is you have no control over what that fund manager does. You're basically saying, hey, I'm going to dump my money into this Fidelity fund. I'm going to pick one of these 10 options that they give me and hope that Fidelity fund manager is doing the right thing with my money. Because if not, I'm going to have trouble retiring. I'm dumping all this money in, and the performance of this portfolio or my 18 cents per mile, thank you, is going to directly affect my retirement. I'm the type of person that would like to be a little bit more in control especially over my future and the things that I do, the things that I do, and that's what a self-directed IRA allows you to do. So a self-directed IRA basically says that you can put money into a retirement account, defer your taxes on it, just like you would do in your 401k at your work. But you can now basically go out and choose to invest in whatever you want to invest in: real estate, gold, stocks and bonds, an LLC of your friend's company, whatever it may be. And you're more in control now. You watch your portfolio and you dictate how your retirement or how you're going to have to, retire there. So a couple things to note. If you have $50,000 or whatever it is into your current 401k with your current employer is not going to let you move money over to a self-directed IRA. That's just the way they're set up. They want you to stay with them. But let's say, for instance, my wife has some cash within a prior employer. She left, and when you change jobs, and I'm pretty sure some of you have run into this, they're basically going to say, would you like to roll all of this old money over into the new account? And most of you do, because you probably want to consolidate everything and keep it together. The other option is you take that old money and you move it over into a self-directed IRA. That's the only time that you're going to be able to move it, is if you take that old money, you're no longer with that employer, you move it over to a self-directed IRA. And now if you have 50, 75, you can dictate what you do with that capital. Invest in real estate, invest in somebody else's project, development project, or whatever it may be. Hopefully that makes sense to you. The other side of it is you can also open up a self-directed IRA outside of your current employer as well and start funding that. So it doesn't have to be old money. It just can't be new money. Can't be new money, can be old money with an old 401k, or it can be new money if you're opening up the self-directed IRA yourself, if that makes sense. Me and you, as you become business owners, or if you're already a business owner, I would encourage you to look at the self-directed IRA. There are other options out there. Some of you may be familiar with them, the Solo K or Solo 401k, where you basically have a checkbook and you can write checks out of your 401k. Just a couple of things to keep in mind. All the gains, let's say you buy a 3-family with your cash. You use the down payment. You have, let's talk real numbers. You have 50 to 65,000 into your 401k, and you use that as a down payment on a 3-family, and let's call it Worcester or whatever, somewhere that's where you can achieve that with that number. You get rental income, you have rental expenses. The thing with a 401k or retirement, this is still a retirement vehicle. Everything that you, all cash flow and everything else needs to go back into this retirement account because that's what it's used for. The government is allowing us, the federal government is allowing you to not pay taxes or defer taxes to encourage you to save money for your retirement. Everything that your investment choices produce or earn needs to go back into this and can be used for future investments to grow the portfolio from there. I don't want to go too deep into it. If you have any other questions, please let me know. Jump them into the box, and we can circle back around and talk about. The last thing I would say is I don't know if he's on today. Maybe he is. Maybe he isn't. Was introduced to a gentleman a few weeks ago, maybe it was a little bit more, a month ago, does self-directed IRAs. This is his full-time job. He blew my mind with some of the things that he was talking about. Hiring my spouse is not on my payroll right now. And he was like, why not? I mean, you could basically be putting, having her do some things, mail marketing, whatever it may be, and putting more money away for her retirement, really maximizing things. Again, if you're living paycheck to paycheck, maybe that's not the best strategy, but if you have any type of, what is it called? Just income that you don't necessarily need right now, disposable income, you should be trying to maximize your contributions and avoiding those taxes. And if you'd like to be connected with him, I can definitely set you up. Send me an email, send me a message through Meetup or whatever like that, and I'll definitely make the connection. But I use the Entrust group right now to have with my self-directed IRA, and I'm almost certain I'll be moving over to this gentleman, after that one conversation that we had, because I really want him to take that wealth building strategy to the next level for him. Another really, really cool thing that you can do, or you should be thinking about as you're running your real estate business, as you're building your portfolio. This is constantly on my mind. Is business travel and education travel, or just business travel and education, in general. So again, I'll talk about myself, just because it's the easiest way for me to, give you a scenario. For me, especially because of the brokerage business as well, there are not too many business-related events that are not tax write-offs for me, right? So if I go see Grant Cardone in Miami, and he has a 3-day event down there, that is directly related to my business, and for both sides. I mean, he's a marketing professional, he's a business coach, he's all these different things. If I'm going to see Tony Robbins or whatever, it has an event in Las Vegas. Those are all business expenses for me. The plane travel is a business expense. The hotel is a business expense. The car that I rent once I arrive there, the price of Tony Robbins or Grant Cardone's ticket is a business expense, for me. So basically educating yourself and continuing to educate yourself. Obviously, you have to put out the money initially to pay for these things, but understand, like I said, the federal government realizes that, and the state government realizes that, this is something that's necessary. I need to, in order for me to continue to grow my business, I need to continue to learn about growing a business and marketing and real estate. And if I want to go see Dave Lindahl or Fortune Builders or whatever it may be, and they're down in, Texas or Austin or whatever it may be, that is an opportunity for me to, get down there, see these people, educate myself, and also use it as a tax write-off. The business, you're asking, well, that's not impressive, Willie. Why would you even mention that to us? Well, the thing that I like most about it is, and again, this is where, like I said, I'm not trying to get anybody on this call audited. You want to make sure that you're cautious about what you're doing and not taking advantage of the system. The more that you educate yourself about, and not fear, taxes and the code and everything else, the more that you'll see opportunities. But if Tony Robbins, why do you think that Tony Robbins and Dave Lindahl and Grant Cardone always have things in Vegas and Miami and some of these really why are they more often in Connecticut and Baltimore? The reason is because people realize, hey, I'm going to go down and I'm going to see Grant Cardone for 3 days, and all of this is going to be a business expense for me during the day. But if I go to Miami Beach, or if I end up on South Beach during the evening, and I have a wonderful evening on South Beach or whatever it is, and I'm going out to dinner and I'm seeing the sights and I'm spending some time on the Strip in Vegas, that's the there's no deduct. I'm not going to say, hey, the federal government is not going to say you can't enjoy yourself during the evening, or you can't spend an extra day there, or maybe it is. Here's where it gets a little sticky though. If you go to a Grant Cardone concert or a Grant Cardone event for 1 day and then spend 4 additional days in Vegas, I'm pretty sure that that's not allowed, right? I mean, that's not going to be, that's the type of stuff that's going to get you audited, get you in trouble, and get the whole trip disallowed. But if you're spending 3 days there and you take an additional day, or you're going out at night, or you have a half day or whatever it may be, you're getting to those places. And maybe it's Chicago. Maybe there's an event, a marketing event in Chicago, and your sister also lives in Chicago who you haven't seen in a while. So you're basically killing 2 birds in 1 stone. Or, often my wife will go on business trips with me as well. And though her plane ticket is not necessarily tax deductible, she's also riding in the car with me that we rented, which is tax deduction. She's also staying in the hotel room with me, which is that's a tax deduction. The meals that we're sharing together are half mine, or I'm half eating, and we're sharing that trip, and a good portion of it, 65-70% of it, we're writing off, as a result. So business travel, educating yourself, getting out, it's a little different than the local travel. You're not going to, total up miles at 18 cents per mile. But again, keeping those things in mind and realizing that, and again, here's the really cool thing. Some of you may be like, well, I don't really, have some property. He owns a business. This is not necessarily just, you can actually do this getting into the business as well. So if, let's say, for instance, you are thinking about buying property in Florida, or you're looking at opportunities in Florida, and you fly down to Miami or Fort Lauderdale, whatever it may be. If you are seriously thinking about buying property there, and you're hooked up with a real estate agent, that trip is tax deductible as well. That's a business expense. You're trying to expand your business. You're getting into a market. You're thinking about the rental property business. Where I think it gets sticky, and again, maybe, and this is one of the things that you want to talk to or research or do your research on, is I think you're allowed to do that for 3 years, and then you no longer can write it off without actually buying something. If you bought something on year 2, you can go down to the next year, and the year after that, and the year after that, and keep going. But if you flew down to Florida 3 years in a row, wrote off the travel, never bought anything, that 4th year, I believe, is the government is now going to consider your Florida travel to be a hobby, or just a vacation. You're no longer a serious investor or thinking about doing it. But that first year, I flew down to Fort Lauderdale looking at property in 2012, 2013, I think, 3 or 4 times, and was very serious about buying something, didn't end up doing it. But could, like I said, it wrote off, I believe, every single one of that, or all that business travel. The other beauty is if you end up buying property in Florida or Vegas or something that you or somewhere where you frequent, and it is a legit rental property, you also need to travel to that rental property too. I wouldn't necessarily manage. I mean, if you want to do it that way, I think that would be a little crazy. But even if you had a property manager, you still need to check up on your property. You still need to go down and have a meeting with the property manager, and conduct business in that neighborhood and potentially look for other property. So that travel is a write-off as well. Just flying into Florida, flying into Vegas, and having a face-to-face with your property manager. Again, if you went out that night and had some fun on town, then like I said, it's not going to be disallowed. So hopefully all that makes sense. And I've always found it really cool, and something that I utilize on a regular basis to not only educate myself and get around, but also to have a little fun. Lead paint tax credits. Some of you may be familiar, some of you may not. I have always traditionally, and not always, but I mean, in prior years, been afraid of the cost of removing lead paint. It's still not cheap. It's still a cost. I look at it a little bit differently now, for 2 reasons. One is that it almost improves your cost. Some of you may argue with me saying that maybe that's not true and you disagree, but I find that especially in the city, it's almost a dollar for dollar improvement in increase in your value for what you get. You put in a new kitchen into a rental property, you typically don't see a dollar for dollar increase in value. A new bathroom, a new toilet. Lead paint removal is something that you see. People are afraid of it. People don't want to buy properties because of children with lead paint in it. So if it costs you $15,000 or $20,000 to remove lead paint from a 3-family building, I can almost guarantee you that property is worth $15,000 to $20,000 more after it's done. The beauty, and like I said, I think I figured this out maybe 3-4 years ago, is anytime that you do that, I did not know this prior, is that you actually get a state level tax credit. And again, not a tax deduction, a tax credit. There is a difference for the lead removal. For every unit you de-lead, and check the numbers again. Last year in 2017, it was $1,500. I actually ended up not spending any money. I got my first tax return from the state in like 10 years because of the units that I was able to de-lead last year under the tax code. So you de-lead 3 units and it costs you 15 grand. you're getting 4,500 back from the state, or the true cost of it is 10 grand. And if the value goes up by 20, you're really in the money. So keep that in mind. We obviously live in the Boston area. Every home here was built in 1910, 1920. Lead paint lead paint laws didn't take effect until 1978. There's a good chance that there's a lot of homes, not a good chance, there are a lot of homes still that need to be de-leaded, and you're going to run into some of them, in your investing career. So I would, like I said, keep that in mind. And again, I want to let me really correct something really quickly. Someone just corrected me on. Let me open this up. 2018 standard mileage deduction rate, 54.5 cents. Jesus, I've been doing this for a while, because I give you my word, it was 17 or 18 cents. Not to be confused with the medical mileage at 18 cents per mile. So it is all the way up to 54 cents per mile. My tax laws are so outdated. So definitely look that up and talk to your CPA, about the tax mileage that you're driving. 54.5% or 54.5 cents per mile. So again, if you're driving, 1,000 miles, you multiply those two numbers, and that is the mileage deduction that you would get for 2018. And I appreciate it. These question boxes are so small, I can't see who exactly sent it over to me, but I do appreciate it. 1 second. Cool. Okay, where are we? Really cool. This is the only thing that I have not yet been able to implement into my business just yet, and for good reason. My oldest child is only 15 months. We have another one on the way, but you better believe that anything that I tell you here is going to be, part of my business really soon. And this is why I think if you listened to one of these webinars before, or come to a seminar I've done, I really do think that everyone should be a business owner. You have to, and when I say a business owner, I don't necessarily mean that you have to run Coca-Cola or McDonald's, or even have a managerial company or whatever it may be. You just want to do something, even if you love your job. You have a W-2 job, your employer is great, you're making great money. You really want to do something on the side, just to create a business, a hobby, or something that you love doing, turn it into a business, some type of internet business, or even just starting a business just for your kids. Because of the tax write-off, there's so many things that you can write off, and you can help yourself or benefit tax-wise. It's just the tax code is so friendly to business that it's almost crazy not to have something in play. So putting your kids to work, or put your kids to work, as soon as my daughter is old enough to hold up a pen, or knows her ABCs and is able to file something, she'll be put to work. And the reason is she's going to want things. She's going to want to go to movies or trips, or spend some time at the mall, or go to a concert, or do whatever it is, device, Kindles or iPads or whatever it may be. If you are giving your kid an allowance on a regular basis, your kid's a little older, and they get something from you, you're taking W-2 money, and your state and federal government is taxing that money. They give you what's left over, and then you're giving it to your kid. You're giving your kid after-tax money. There's no problem with that. I mean, you love your kid and all, but if you basically say, come into our home office and spend some time sending out these investor mailers. I want to get a mailer out to everybody who owns a multifamily in Roxbury or Melrose or whatever it may be, because I'm looking at buying those. You look these envelopes, stuff them, stamp them. That kid is now, in my opinion, learning how to work. You're providing them with a great work ethic, and then you're also paying them, a wage, and that money is now tax deductible to you and your business. So you actually have to write that off. So instead of giving your child after-tax money, you're now giving your you're creating making your kid an employer, and giving them pre-tax money, if that makes sense. So whether it be, going over to your rental property and sweeping down the steps. Great. Now your allowance turns into a salary. Going over to the rental property and mowing the lawn, or trimming the hedges, or just picking up trash, or taking the barrels to the street. Whatever it may be, whatever little things that you can get them involved in, filing papers, holding up a paintbrush and enjoying a day with dad or mom, going over there and just painting a room, and learning how to get things done, within the property. That cash that you're giving them now to go to the movies, to do the things that they want to do, they've earned, and now it's a tax write-off for you. So again, maybe some of you may be, you just kind of want to just hand the kid money and not necessarily, go through the difficulties. But if you have enough children, then it makes sense. What else can I tell you about that? So one of the things that I also talked to my again, I don't know much about this. I just want to put this out here. You can kind of do your own research on it. Is if you're a business owner, putting your spouse on the payroll as well. I told you that my self-directed, contact, I had mentioned that to me, and it's something I'm seriously considering as well. Using some of our disposable income to further push into a retirement account and bolster, my wife's retirement savings. I think one of the things that you want to think about, and somebody may be able to look this up as well. You don't necessarily have to, but you can look this up later on if you'd like. Obviously, you can't pay your kid $50,000. Excuse me. You can't pay your kid $50,000 a year, or you could, but obviously that you're going to push them into a tax bracket where now they have to actually, pay taxes. I believe, if I'm not mistaken, I may be a little bit outdated on this number as well. I believe it's $12,000 to $15,000 that you can have. You can pay your kid, and they don't have to worry about taxes. It's more or less on the tax bracket side. If you make less than $12,000 to $15,000 a year, somewhere around that number, you're not really concerned with taxes. So you probably wouldn't want your kid to exceed that number. And if they do, if you basically say, well, I have a 16-year-old and that's all he wants to do is work. He wants to cut grass, and he's really good at it. He wants to sweep downstairs, and I pretty much use him as a property manager. And he exceeds. Maybe you start to encourage your kid even at a very early age to start open up their retirement account and start deferring some of that. So they really, like I said, they're making 20, put 5 away, put 6 away, knock it back down to that under that $15,000 number, or whatever the number is. So they're not having to have a tax burden necessarily. So hopefully all that makes sense. What else did I have for you guys? I believe that was it for this morning. We took about 50 minutes, just under the 11 o'clock hour now. I'm going to stick around if you have any questions, anything that I wasn't able to cover, anything that I didn't, get a chance to go over. Again, I'm not a CPA. Have a conversation. Anything you've heard this morning, have a conversation with your accountant, whoever files your taxes. Professional in the business. Have a conversation with your attorney about legal, entity structure and everything else. But I guess what I would leave you with is, don't look at the tax code and look at the your taxes as an opportunity. It's not something that shouldn't be looked at as kind of a burden, something here I have to do again. And, that's, wealthy people and people with, a substantial amount of, money or wealth are looking at the tax code as great opportunities. They're looking at it as, how can I, within the code, save myself some money, make some more money, defer the money that I've made, defer the taxes on the money I've made until a later date, compounding the earnings in my retirement account. So, look at the tax code as an opportunity, continue to read up on it, talk to as many professionals as you possibly can in the retirement department and the accounting fields, and just learn as much as you can, because there's a lot of opportunities there to, put some money back in your pocket. One second. See if we have any questions. What are some of the tax subtle differences between W-2 professionals who are part-time investors, for example, owner-occupied with a tenant versus full-time? Good question. So let's say you own a multifamily and you live in. I assume this is what you're asking. You live in the building, and you also have a W-2 to income. There are not many differences in terms of, like, you can still take travel, expenses. You're trying to build a business. The only thing that would immediately come to mind is you can't write off 100%. So I have a three-family in Dorchester, and I buy rock salt, leaf bags, rakes, snow blower, or whatever it may be. Those are 100% write-offs for my rental property. If I live there, a snow blower and rock salt and leaf bags are typically paid with after-tax money. So what you would have to do is, again, your accountant should be able to figure this out pretty easily. It's a three-family, and I lived in, a couple of my rental properties prior. I basically just wrote off 66% of the cost of those items, right? So my interest tax deduction, 100%. My depreciation, 100%. And then I would itemize or line item, hey, during the year 2018, I bought this much in leaf bags. I spent this much in rock salt. I spent this much on shovels and rakes and other tools and a snowblower. Those things would be write-offs, but only at a 66% ratio, basically discounting my unit, if that makes sense, right? If I lived in a single-family home, none of those things would be tax deductions for me. Those would be all just expenses that I would have to pay with my money. But because I live in a three-family, occupying one unit and tenanted the other two, I have a two-thirds or 66% would be tax deductible. If it's a two-family, it's one-third. If it's four-family, it's 75%. Excuse me, one half or 75% if it's a four-unit. So that's the only thing that immediately comes to mind as a difference. But again, I don't think that if you're a business owner and you occupy a portion of your rental unit as a home office, you should still get a home office deduction. It's going to be a lot less of a percentage, off of those total expenses. Travel, education. You're buying books. You're going to a seminar. You're hopping on a webinar that you have to pay for. Whatever it may be. Make sure you're saving every single one of those invoices or those receipts because those are expenses to you. So not too many differences. Just like I said, just what you do to improve the property. If you put a new roof on your one of the questions I would have is, if I put a new roof on my three-family, I would think that I would get 100% of that, but that may be only 66% as well. So those are one of those questions you probably have to ask your CPA. Let's see, and I believe that's it. No other questions? Oh, no, hold on one second. Maybe a quick word on depreciation recapture. Depreciation recapture. And again, I assume what you're referring to when you go to sell a property, when I mentioned depreciation expense to you, it's an expense that the government is making you take. You're going to have to take depreciation expense. But because you're taking it, when you go to sell that property, or you eventually, your cost basis is being reduced by that depreciation, and it's going to be recaptured, so to speak, when you go to sell the property. So again, that's something you probably should talk to you about your CPA. I really have to, in order to really show you that, I really want to put some numbers on the screen and make it, show a little diagram about, hey, if I bought it for $400 and I took $100,000 in depreciation, and then I sold it here, when would you have to recapture that? So that gets a little complex, but that's what depreciation recapture is when you go to sell that property, you're going to have to, the depreciation expense that they gave you is going to need to be re-upped at some point. And hopefully that answered your question, or got you to where we want to be. So again, I appreciate you hopping on this morning. Hopefully this was eye-opening in some respect. Not a CPA, not an accountant, but like I said, I've been doing this long enough to know the questions to ask, and that was what I was trying to get at with you today. Is I wanted you to know enough to know where you should be, what you should be Googling, the YouTube videos you should be watching, what you should be talking to your CPA and your accountants about. and pick up that book that I mentioned, that NOLO. It's NOLO. You can find it on Amazon. I believe they come out with a version every year, and it basically gives you tax deductions and strategies. And um, taxes for most people are pretty boring, but I would say kick that. Try to learn as much as you can, and I can almost promise you're going to save and put a lot of money back into your pocket. Especially if you want to be in this business for a long time. So again, hopefully you enjoy your weekend. If I can help with anything, please reach out. My contact information is on the screen. You can also reach me at Willie@Mandrelco as well, WILLIE. And like I said, if I can help with anything, reach out and we'll chat. All right. Have a good weekend.